What if I told you there was a way to get uber rich that no one seems to be talking about? 20% a year returns are junior level in this industry. It's time we take a deep dive into the profitable yet ugly world of predatory lending. If I told you I could help you earn 400% returns a year, you'd think I was one of the worst fake gurus. Not in the world of payday lending, where millions of Americans are taking out small loans at rates that can reach 400% a year or more. There are more payday stores in America today than there are McDonald's. They're making millions of loans each year. Instead of McDonald's making $1 grilling a hamburger, they could 4 times their money serving customers loans. McDonald's would finally be making enough money to fix their ice cream machines. Payday loans are so lucrative that loan sharks call them for advice. If someone came to you and said, "I'm going to take one of these payday loans out," knowing what you know, what would you tell that person, asks Pelly. "I'd say go get a loan shark. They're cheaper," says Blaine. "A loan shark only charges about 150%. Why would you go pay 400%? Any other choice on the planet is better." To show you how ridiculous payday loan stars are, a credit card at 20% interest is only 5% of the cost a payday lender charges per year.
No doubt you've seen them. They're as common as convenience stores. 10 years ago, they didn't exist. Now, there are more than 22,000.
Getting a loan at these places is just as convenient as beating your meat, and in the end, you're just screwing yourself. Payday lenders operate by providing quick loans to people in complete desperation of money. Their customers are willing to pay insane interest on their loan tomorrow in order to receive cash today. 18 states and DC either have laws that explicitly prohibit payday lending or have low price caps that effectively do so.
After 9 months, the total amount they owed grew from $1,200 to over $3,000. That's an annual interest rate of more than 300%.
No one in their right mind would accept 300% interest on a loan, which is why this industry exists. Their customers are in a position where 300% interest is a better option than not having the cash.
The point is, what is a payday loan?
What is a payday loan? A payday loan is a quick way to get the cash you need to cover an unexpected expense, like a car repair or a doctor bill. It's called a payday loan because the loan balance is typically due on your next payday.
Business names are simple and easy, like Speedy Cash cash loans, Rapid Cash loans, Easy Check Advance, DollarWise, and Easy Money. California has the highest number of payday lenders, 2,451, more lenders than any other state. Whether it's California or sunny Las Vegas, you can find these lenders if you know where to look. Unfortunately, they do mostly exist within low-income communities because those are the people typically falling into a financial trap.
You all know, and I know, that too many Virginians are getting caught in financial quicksand with these products.
A majority of my videos are highlighting how you can protect your money from bad investments, so it's important I mention today's sponsor, Aura, the all-in-one suite of online protection and digital safety. When I first used Aura, I was impressed and horrified at how much of my personal information it was able to find. By scanning the deepest parts of the dark web, Aura finds and removes your personal information. This prevents scammers and hackers from getting their hands on your stolen passwords, emails, and social security numbers. Aura also includes a ton of other features like virus and malware protection for your computer, a VPN that allows you to stay anonymous online, and fast alerts when it detects suspicious credit inquiries, so you'll never have to worry about someone buying a Lambo using your credit. And it also includes a password manager to create and store your passwords securely. Gone are the days of coming up with new passwords that have 8 characters, a capital letter, a symbol, and the Colonel's 11 secret herbs and spices. You can do everything I mentioned and more, all with Aura, so try Aura today by going to aura.com/Spencer, scanning the QR code you see on the screen, or clicking the link in the description below. By using my link, you'll get a 2-week free trial to see just how much of your data is compromised. Back to the video. Politicians have figured out that there's 2 ways to get rich easy in America. One is to gain access to Nancy Pelosi's private Discord, where you can make the same trades she makes, and 2, you can invest in payday loan companies and adopt policy to keep them operating.
At the end of 2002, there were 49 payday loan licensees operating 377 offices in Virginia, having made 4,000 loans.
More than 500,000 loans originated in Virginia alone that year. Think of how insanely simple this business is. These stores are located in areas where the cost per square foot is at the lowest. They don't exactly need any renovations or much expenditures to get up and running, and all they're doing is lending money without an underwriting department.
Extending credit to people in a way that sets them up to fail and ensnares considerable numbers of them in extended debt traps is simply not responsible lending.
I consider this industry predatory because the customers have a price inelastic relationship with the product, meaning they will pay whatever cost to attain the loan because of the situation they're in. Henderson city councilman sued for predatory payday loans charging 700% interest. After reading the complaint for this politician, I realized I needed to tell this story.
To make it affordable for our workforce.
Henderson City Councilman Dan Shaw.
My estimation, this is probably the most critical committee that we have right now.
Championing the cause of the working man.
The defendant in this case is Green Arrow Loans, which is a short-term lender providing their services through their website. They claim the entity that owns the website was created and owned by the Big Valley Band of Pomo Indians of the Big Valley Rancheria. This is not the case.
This community has a critical need for workforce housing.
All part of being an elected official. Along with the hand clapping, handshaking,
we pray that our leaders will lean on,
and head bowing you might expect from a city councilman.
Dan Shaw and Gregory Jones are two defendants in the lawsuit. Their company, Nevada Impact Management, manages Loan Tracks LLC and Integra Financial Services. They allegedly began Integra Financial Services in 2011 to acquire all of the assets from a company called Impact Payment Systems, an internet lender. Impact Payment Systems had been sued by the SEC in March 2011 from allegations that it was a Ponzi scheme that raised $47 million to lend. Shaw and Jones weren't owners at the time, but it's odd to me that they'd want to even be associated with a company sued for being a Ponzi scheme. Clark did not deploy investor capital to make payday loans as represented, but instead diverted investor funds to maintain a lavish lifestyle, including buying expensive cars, art, and a home theater system. Clark also misappropriated investor money to fund outside business ventures and used new investor funds to pay purported profits to earlier investors. The lawsuit states they bought the assets and operations of this company, but a Ponzi scheme doesn't exactly have assets, so I'm not sure what the purchase and sale entailed. On the bottom of the Green Arrow Loans website, the text appears in super small writing. Green Arrow Solutions is a tribal enterprise wholly owned and operated by the Big Valley Band of Pomo Indians, a federally recognized American Indian tribe and sovereign government. The lawsuit alleges that is false.
There is no state license, just this little certificate from the tribe.
Hey, Kyle, this is Ben Ray returning your call, and
KLAS 8 reached out to the tribe to confirm they weren't associated with the company. Because federally recognized tribes are sovereign nations, they can operate under tribal law without interference from state governments. Tribal lenders partner with these tribes and claim immunity by extension, which they use to get around legal protections for consumers. The lawsuit further alleges that Shaw and Jones are not members of the tribe.
And Green Arrow can skirt state interest rate caps, usually around 12%, and charge up to 750% interest, making a $500 payday loan a $1,700 repayment.
Companies offering tribal loans always claim to be wholly owned by a Native American tribe. They have to make that claim to be immune to state law. Many of them are actually operated by outsiders who have nothing to do with the tribe and are simply using it as a front. The lawsuit alleges that the business operations of Green Arrow Loans take place outside of the tribe's reservation.
Some 30 cases against him and his business holdings for breach of contract, non-payment of loans, debts, failure to pay employees, and other commercial wrongdoing. Not to mention having owed millions to the IRS.
Many states' laws state that you cannot lend money at an interest rate in excess of a certain statutory maximum. This is a usury limit. This law attempts to prevent predatory lending. Attempting to circumvent state interest cap rates by fraudulently hiding behind tribal sovereign immunity has been found to constitute criminal conduct. Using upcouncil.com's chart, they list out a state-by-state usury limit, with most states having a cap at around 12% to 17%. The incentives for lenders like Green Arrow to circumvent the law and falsely associate with a tribe are pretty obvious. 700% interest is a lot more than 12%. The plaintiff in the case provided his loan agreement with Green Arrow Loans. He took out a loan for $500 that had a finance charge of $1,201.64, which is an APR of 755.91%, resulting in a total payment of over $1,700. All of the terms are disclosed, so the lender isn't breaking the law in the sense that they're hiding how much they're charging, but this is an extreme penalty for someone to borrow a small amount of money.
No attempt is made to determine whether the consumer will be able to afford the ensuing payments, only that the payments are likely to be collected. Indeed, in many of these markets, the lender's business model often depends on many consumers being unable to repay the loan and needing to borrow again and again while incurring repeated fees.
What seems to happen with these types of loans is the borrower needs a small loan in a tight situation, and the excess of fees and interest rate makes it incredibly challenging to pay the loan back abruptly.
Based on our review of millions of transactions, we found in our own research that for about half of all initial payday loans, borrowers are not able to repay the loan without renewing it.
This creates a type of borrowing Ponzi scheme where the borrower is constantly asking for new money in order to pay off the old, and the excessive fees and interest rates makes it nearly impossible to fully pay off the loan.
More than 1 in 5 initial loans turns into a repeating sequence of 7 or more loans. The amounts that people borrow in each successive loan in the series is usually the same or more as the initial amount borrowed.
These lenders create a debt trap where the borrowers can never escape because their next paycheck can't cover the loan, so they need to borrow more and it never ends. There's a fair argument on the side of the lender that borrowers put themselves in this situation and everything is disclosed, therefore the borrower is never tricked or deceived. In the subreddit Change My View, a commenter by the username LEARHPA posted a great comment regarding this. I think it's unethical to take advantage of someone else's weakness in a way that does harm to them, as opposed to taking advantage of someone else's weakness in a way that is good for me and neutral to them. Lenders charging 750% for loans that aren't available anywhere else in the marketplace is predatory in my opinion, because it's insanely beneficial to them and insanely damaging to the borrower. Payday lenders are clearly doing that. They're providing a tempting service with restrictions and rules which the overwhelming majority of their customers don't understand and or can't abide by, such that it is inevitable that the majority of their customers will be hurt rather than helped by the interaction with the lender. A small percentage won't, because that percentage has the skill to research and understand the situation, but most will be hurt, and the payday lender is relying on that.
Fast Cash, you've come to the right place.
They use high-energy commercials and bank-like storefronts to entice people to borrow money at triple-digit interest rates. The problem? They are rarely short-term. Borrowers frequently need to take out a second loan to pay off the first one. It's called flipping.
There are, of course, going to be people who abuse this system, borrow the money, run off, and never have any intention of repaying the loan. It's a form of borrower fraud, and the company is left holding the bag with nothing to collect on. This is a risky business.
The average payday loan in the United States is flipped 8 times. They're a debt trap that's intentionally marketed to the financially unsophisticated, intending to lock them in on something that they can't pay back.
Because it's a risky business, higher interest rates are naturally the outcome. However, I think we can all agree that the absurdity of multiple 100% interest is past the acceptable point. Business owners operating payday loan centers will argue that reasonable interest rate caps will sink their business. My argument is that if your industry requires 250% to 750% interest rates on loans to operate, then you're essentially a loan shark and shouldn't be in business.
As a small lender, we had to consider ability to repay. We were responsible lenders. We didn't have unlimited financial resources. If we loaned money to people who could not repay the loans, we would no longer be in business.
I equate it to a real estate investor overpaying for a property and then demanding that the tenants pay double in rent knowing they have nowhere to move to. There are more payday stores in America today than there are McDonald's. They're making millions of loans each year. I use that quote again to prove a point. If the business had super low margins and couldn't reduce its predatory rate at all, then the business wouldn't be thriving in every state it is allowed to operate within. More stores than McDonald's. I think a fair argument can be made that the true guilty party in this industry is the culture within America that decides to not repay loans. If you removed the bad actors receiving these loans that have no intention of repaying, I would anticipate the lenders being able to reduce their interest rate to a more favorable rate and the borrowers not having to get caught in a debt trap.
Now, to be fair, payday loan companies will say these are short-term loans, so an annual percentage rate doesn't apply, which is true if you pay them off immediately. But many customers don't.
My belief is that a lender offering something significantly more fair with just slightly more underwriting can offer great short-term loans at a much better rate and operate a business with healthy profit margins. Payday loans are meant to use people's paychecks as collateral, meaning they're lending to people who are employed.
Customers don't. One study showed that 3/4 of the industry's volume was generated by borrowers who have to re-borrow before their next pay period.
These people don't have the risk profile of someone deserving of a 700% interest rate loan. 60 Minutes interviewed someone for their story. She's paying $1,200 a year for a $300 loan. Because I can't pay it back, says Harris. It's like walking through a spider web and trying to get all the web off of you. I can't get out of it. Just like with spiders entrapping their prey, the point is that you can't escape the web.
You'll notice that has a certain roundness to to it. It's basically a recycling symbol for human misery.
Payday loans, title loans, quick cash, easy cash, cash advance, all of these businesses are awful in my eyes and do more harm to borrowers than help. An interesting corollary to predatory lending was the mortgage industry pre-financial crisis. While the borrowers certainly deserve blame for overextending their debt liabilities, many lenders offered loans to consumers knowing they'd likely default and not caring because their risk was passed to someone else. The third parties buying the mortgage-backed securities were the ones ultimately left holding the hot potato. And what about student loans? They don't have predatory interest rates, but I'd argue they're at least distant cousins to payday loans. Colleges dangle future employment and the value of a degree in front of 18-year-olds with the only obligation to sign on a dotted line for this thing called a loan they barely understand, which isn't a big deal, right? The federal government should get out of the student loan business. With nearly no limit on the amount students can borrow to help cover the rising cost of college, there is an incentive to drive up tuition, she said. As a result, it takes people 17 years on average to pay off their education debt, data by the U.S. Department of Education shows. Many 18-year-olds are signing up for significant debt without understanding what taking out a loan really means and what the job market looks for in prospective employees. Lender taking advantage of the borrower not fully understanding the repercussions of their decision sounds like predatory lending to me. There's a massive difference between good debt and bad debt. Good debt helps to increase your income while bad debt gets you stuck in a trap. Choose wisely, my friends. Thanks for watching.